Hi, everybody. Thanks for joining me. Before we get started, I'd like to ask you to hit subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the 10 best stocks to buy right now. So, Simon Property Group is a stock that I added to my portfolio at the depths of the COVID pandemic. I know you and I both did a lot of buying in the real estate sector at the depths of the pandemic because a lot of these companies were priced like nobody was going to go to the mall again. And clearly that's not true. So Simon had they're the mall REIT. They at one point they were the largest REIT in the world. Not so anymore. But their asset quality is completely unmatched in retail. If you've ever been to a Simon mall, it's more of a destination than a shopping place. Simon malls are very, very busy right now. Consumer spending is very strong, which is kind of surprising a lot of people given what's going on in the economy with inflation and things like that. The number of consumer transactions, according to Bank of America's recent data, was actually up across every major spending category in the third quarter. That really surprised a lot of people. Simon, they're doing a great job of bringing in retailers to their properties that don't have locations anywhere else. I'm wearing an Untuck It shirt, which you used to be able to just buy online, but I bought it at the Simon Mall in Charlotte, North Carolina. That's just one example, and I didn't wear the shirt just to be able to say that. It just happens to be on me right now.
Sure.
And Simon, they have the financial flexibility to keep their malls better than their peers. They have a lot of liquidity, which I know it's a terrible time to want to borrow money. Simon has about over $7 billion of available credit. I don't want to see them use it. They do have over $1 billion of cash on hand, which is a nice luxury to have in a rising rate environment. They've been able to raise their dividends several times in the past year, still have a very low payout ratio. And they announced a $2 billion buyback, which buybacks are really rare in the real estate space. A lot of REITs, if they have excess capital, they use it for acquisitions and stuff. So for them to say that we see this stock as such a great bargain, we're going to spend $2 billion on buybacks, that tells me something. So, Tyler, what do you think about Simon?
I'm not hyper bearish on the company in any way. I think a lot of the points you make are very valid and makes for a good argument for them. The things that just would give me pause about them a little bit like you were talking is the acquisition growth. Like where does the next steps from here come? And that's where I'm starting to wonder where it comes from. Just, we were talking about acquisitions not really there. And, development is, I actually would prefer with these very large real estate companies to go towards development right now because you can spread out your cash expenses, use a little bit of your internally generated cash to do it and not have to rely too much on outside equity or debt financing to make a lot of it happen. Good time when debt and equity are more expensive. But right now it's internal development pipeline's a little bit small, right? It's got 37, $34 billion in total assets before depreciation, and it's spending about $700 million a year on development. So like 2.5% of its assets in growth. So that's pretty modest amount of spending for a company of that size. And my question is, it's kind of sclerotic growth, and obviously the FFO is pretty high, so there is room to bring up the dividend to those sort of levels. But where is the FFO per share growth going to come from here? Buybacks is going to help a little bit, but eventually we're going to have to start getting some true FFO per share growth from development, and it's just not there right now. And I would be concerned where 6% dividend yield's good, and we could get some returns there. But I think your upside for that company right now is kind of betting on a valuation boost of being like everyone else going, oh man, this stock is so cheap, it has to go that way. And I think one thing that we have seen in 2022 is you can't really bank on that. Like stocks sometimes get cheap and they get cheaper. And so I wouldn't want to overexpose myself to something where you're betting on something that you see as cheap is just going to go, be revalued at what you think is fair value.
Fair enough. So, I like Simon. I agree that their growth potential, at least in the near term, might be a little bit limited. Um, one thing they are doing is adding on to their current properties, like and non-retail elements, like they're building hotels onto some of their properties. I see a fair amount of growth potential there because a lot of them don't have a lot of these features. But
Yeah.
I definitely that's something to think about.
They're also a little bit, when it comes to beyond the short-term investments, this is basically like what we can see in their financials. They kind of keep longer term development pretty tight to the vest. Like, they don't do big like splashy presentations telling you where they're going to be from here. And so without like some guidance on what that longer term vision is, you're kind of, sticking your finger in the wind and going, okay, this might be where it goes.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.